Hey everybody, it is good to be here. My name is Brent Moores. Time for investing in dividend stocks. And I'm excited about our topic today. It's one I've been wanting to do. I don't think it's been done before, at least in this iteration of this webcast here. So we're going to hit that up in just a few minutes. I'm going to tell you what that is in just a minute, but it's a popular approach to dividend investing. It's kind of a famous approach to dividend investing. But we'll do that in just a minute. But before we get there, let me just mention a few things. One, I'm joined in the chat by Scott Thompson. Appreciate Scott here. Hey, you guys can all follow us on X. Put additional financial content throughout the week on X. X handles are at Scott Thompson CS, at Brent Moores CS. Also, let me mention this. The material today is intended for general, informational, and educational purposes only. We'll look at individual stocks today. Those stocks are not recommendations. Um, there are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. Schwab does not recommend the use of technical analysis as the sole means of investment research. The paper money software application is provided for educational purposes only. And all investing involves risk, including loss of principal. Past performance is no guarantee of future results. I'm not planning on going through REITs today, but risks of REITs are similar to those associated with direct ownership of real estate. By the way, I did cover REITs last week in this webcast there. Diversification, by the way, does not ensure a profit and does not protect us against loss. Okay, let's do this. Let me go and I'm going to head on over to the Thinkorswim desktop software, which I'm planning on using today. I've kind of gone both ways in this webcast as I've subbed in. Cam, I think, is back in 2 weeks. He's kind of the regular instructor on this class. He'll be back in a couple weeks. But I've done Schwab.com. I've done Thinkorswim desktop software. We're going to do Thinkorswim desktop software today. So, hey, I see some familiar names in the chat too. Glad that you're here. So what I want to talk to you about today is called the Dogs of the Dow. Have you guys heard of that? The Dogs of the Dow. Maybe you've heard of it. Some of you are probably familiar with it, and some of you maybe have never even heard of it. And some of them have probably heard of it and aren't familiar, don't know the details of it. This is a rules-based approach to investing. There's not really, the way it's presented traditionally, there's not much discretion in any purchases that you're making using this. It emphasizes yield, looking at dividend yields, and it's a potential value play on a stock as well, on stocks as well. It's a very mechanical approach, very systematic and mechanical. A lot of people like that as they're investing, but that's what we're going to do today. So now, what is the Dogs of the Dow approach? Let me just define it for you. What we're going to do is we're going to take the highest yielding stocks in the Dow Jones Industrial Average and buying them. It's typically done annually. Traditionally, it's done annually. For a lot of people, it's done at the beginning of the year, January 1st or the first week of the year, something like that. There's no reason it needs to be done that way. You can do this anytime that you want, but traditionally it is done annually. It's not a short-term trading approach. It's a longer-term approach, and you may very often it's done repeated on an annually basis. Okay, now it's done with the Dow. Could you do a similar type approach with a different index? You probably could. But keep in mind, the Dow is made up of 30 stocks, typically considered more blue chip type stocks. And so there we go. That's kind of the theory on this. But let me just kind of show you let me kind of give you an illustration. I'm just going to bring up Microsoft. Microsoft's not a huge dividend payer, but what I want to point out to you is this as we look at Microsoft. And that is, as we do this, this is a script. Actually, let me get out of this for one sec, and I'm going to just expand this a little bit. This is a script that is not standard in Thinkorswim. It is, however, one that I'm sharing the script with you. I'm going to share it both in the chat. I'm going to put that in the chat right there. And also, for if you're watching on a recording, I've added it to the description of this webcast. Now, scripts aren't guaranteed for accuracy or timing. Ken Rose, many of you know, was an old coach here, and we love Ken, and he did a lot of scripts, and he created this script. And one of the notes he said on this script is, it's best to use on a 5-year weekly chart. Okay, so that's what I have here, a 5-year weekly chart. So there you go. That's this. Now here's Microsoft, not a big dividend payer. The green line shows the dividend, but what I want you to see is this. As the stock goes down, here's a period where the stock went down. What happened to the dividend? The dividend went up. Okay, you see that? And then the stock rose. Stock rose here, and the dividend went down. This is not a coincidence, by the way. The stock dropped, and the dividend went up. This is the dividend yield that we're talking about here. The stock went up, the dividend dropped, and the stock dropped, the dividend went up. Now, why would this be? Well, keep in mind, when we talk about dividend yield, what's a dividend yield? The dividend yield is just the annual dividend divided by the share price. So if the share price is going higher, that's the denominator of the equation, then the yield is going down. Share price going up, yield goes down, and vice versa. So you can probably see where this is headed. If the share price is dipping and the yield is up, if you buy the highest yielding stocks there, that could be a potential opportunity to buy something that's dipping down. Now, of course, there's a big assumption there with this, and that is that it's going to recover at some point. It may not. This is definitely not a trend trading approach here. This is much more contrarian than a trend trading approach. This is more of a value approach. We're trying to find a stock that's cheaper. Of course, the danger is the stock just keeps going down and down and down. But you can see, I think this is just a random, I just kind of I use Microsoft quite often as examples in this because it's a company that everybody knows. It's not a recommendation, of course, but I think it illustrates what you can see here. Now, on this script, there's the green line. This represents the yield. This is like the 15th percentile, and this is the 85th percentile, the red lines on there, okay? So let me get out of this and let me go back here. So that's the theory behind this approach. Let's go and actually do it. So you can pull up the Dow. You can pull up a watch list. I have a watch list created right here, but you can always create a new watch list on this Thinkorswim desktop software. You just click on the plus sign and it gives you the choice to click on a watch list. I'm not going to do that because I already have one. Once you have a watch list up, you can click up here. There's public watch lists. I'm going to use the Dow Jones Industrial Average. Again, I already have it up, but you just select Dow Jones Industrial Average. It's going to list out the 30 stocks of the Dow right there. All right. Now, in the chat, Paul said, hey, I mentioned if you don't use the Dow, you could possibly use other indexes. And Paul said, hey, would we use a market cap limit on those? Yeah, likely a lot of traders probably would use a market cap limit. Maybe though, there's another approach though that, that says, hey, as long as the dividend is as long as the dividend is there, we can use smaller companies. But in general, that theory is this is more of a blue chip type approach. So bigger companies are the traditional way to do it, which is why we're going to stick with the Dow here for now. All right, we're going to look at the Dow as this. So we're going to start with the Dow. That's how you bring up the Dow. You need to look at the dividend yield. And what the traditional approach on the Dow is, you take the 10 highest yielding stocks, you take the 10 highest yielding stocks in the Dow. You can add that yield column, just click on the little gear right there. You see that little gear? Click on that little gear, and when you click on it, click on customize, and then you can go down, it's alphabetical. You can go down to the Y's, there's yield. I put it on, and then you can sort by the yield, okay? A couple stocks don't even pay a dividend, and then there's some that pay a very small dividend, right? 0.8, Microsoft was one, a relatively small dividend. The average dividend on the S&P 500 is just a little bit over 1%, I believe, last I checked. I'm not sure what it currently is. But you can kind of see, here's the highest dividend paid, a 6% dividend on Verizon. Nike, 3.7%. You would take the 10, you can count down 10, 1, 2, 3, 4, 5, and so on, down 10, I think it ends up being about there, of stocks, and you would buy it, okay? That's the approach. Now, this is not a guarantee to do it. Traditionally, you would buy an equal allocation of each one, equal dollar allocation of each one. Now, an equal dollar allocation doesn't mean an equal share allocation. A $43 stock, 10 shares of a $43 stock is very different than 10 shares of a $311 stock. But we allocate equally and we hold it for a year. And then you do it. Now, I've seen variations where you double up the amount on the top one or two yielding stocks there in that case. And then it's kind of a rinse and repeat process there on that. That's the process in general. I would encourage you, if you are going to do it, to be consistent with how you do it. In other words, if you're going to buy in the first week of January, then you would do that each time. If you're going to buy in the first week of July, you can do that each time. Doesn't matter there. Now, pros and cons. I've mentioned some of the pros and cons here. Pros, one, we're looking at blue chip companies for the most part. Blue chip doesn't mean they're going to go up, but it just means they're kind of older, established, larger companies. Okay. They obviously it's providing a fairly high yield. So if you're looking for higher yields off of more established companies, so we're not talking about a super high yield off a fly-by-night company here. It's a higher yield off a more established company. It's a disciplined system. It's a rules-based system. There's less discretion. It's a pretty simple system in this regard compared to a lot of systems out there. And now, it gives you possible exposure to undervalued companies. In other words, when the stock has been depressed, with the theory that there's going to be some sort of a mean reversion in it. Is that going to happen? I don't know. It doesn't always happen, definitely. There are stocks that just go down and down and down. It reduces emotional decision making. Okay? Do you get caught up with fear or greed in the market? This mechanical-based approach reduces just the effect of emotions on there because you're just doing a systematic approach there. It encourages consistency in your trading. A consistent approach, whether it's this approach or a different approach, encourages consistency there. It doesn't, however, mean that it's a low-risk strategy. Now, let's talk about some of the risks, okay? First of all, dividend yield isn't everything. You can find something with a high yield. Let me just click on Verizon. Verizon has a very high yield, highest yielding one here, 6%. And in this case, it's it's the spike in the yield corresponded to a low. But if you go back, even back at this point, the yield was still 4 or 5%, and the stock went down. And this is true for any time you're investing with dividend stocks, looking at yields. And that is, you can kind of lose the forest for the trees here right now, because if it doesn't matter how much it's paying in terms of dividend, if the stock drops a lot, you're probably going to be in a hole on it. Stocks can typically drop a lot faster than you can bring in dividend payments there. All right, so just be careful on that. By the way, if you're interested, where do I see dividend payments on my Thinkorswim? You can just go to the Monitor tab, go to Account Statement. Sorry, it's a little slow here. Go to Account Statement and go to your cash and sweep vehicle. And then what you need to do is, and dividends will show here in this area. It's not going to show in paper money. Paper money does not pay dividends. So just realize there's a difference there between your live platform and your paper money platform. Okay. It can be, so the danger is it's a dividend trap. Some of you are familiar with that term. A dividend trap means it's an alluring dividend, okay? The high dividend is the lure, but you're trapped into a bad stock, a stock that's going to go down a lot. And there you go. Now, question in the chat, JJ, dividend stocks or value stocks? Dividend stocks are not necessarily value stocks, but I will say, I'm just going to make some generalizations here. The high growth stocks typically, you can think of your larger tech type companies, okay? Your NVIDIAs of the world or whatever, okay? They tend to have the theory that we're going to pay less out in terms of a dividend. We're going to take the money that would be spent on a dividend and reinvest into growth. So higher growth companies tend to pay lower dividends. Value companies, which are often more established companies that aren't growing as much, tend to say, hey, their investors want more of a dividend, and so they tend to pay a higher dividend. So not necessarily, but there is a general correlation between growth and value companies and lesser dividends and larger dividends. But just because it's paying a larger dividend doesn't mean the stock's going to go up. Okay. All right. Now, one thing with the Dow, dogs of the Dow approach, negative maybe, is you're limited to 30 companies here. Okay. So now there's a pretty good diversification among different companies in the Dow, but you are limited to 30 companies. And some of these do share a sector, okay? And so therefore, you could end up with some pretty significant sector concentration risk there. And what we mean by sector concentration risk is that you get a bunch of stocks in a similar sector, they often will perform together, either go up together or go down together, so you end up with a little more risk there in that way. Dividend cuts can happen, okay? They do happen. Stocks pay dividends and then they stop paying dividends. Let me just look. Now, Intel is not a great example because it's made a huge turnaround here, but you can see it was paying a dividend. That's the green, that was the green circle, dollar sign on the chart. Dividend, 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 dividend. It was going through some really tough times, and then it cut the dividend, okay? Now, subsequently, and you can see the dividend cut to zero there. Subsequently, it has not resumed a dividend, but the stock's gone up. It got investments from the government, among other things, and of course, just the whole geopolitical structure has changed here on this. But that's how that works. Let me just see if there's anything else. Oh, one other thing I would mention, and something I'm not going to talk about much because I can't talk about it much, and that is whenever you're dividend investing, consider the tax consequences of your investing. There are differences in terms of tax law regarding dividends versus capital gains. Okay, so you may need to talk to your tax advisor on that or do some research on that. And I'm not allowed to talk about that, but just realize that is something whenever you're considering tax, whenever you're considering dividends, consider the tax implications of this. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. The traditional dogs of the Dow approach would say these would be the 10 stocks that you buy. Okay. Now, of course, it's not a recommendation. However, what are the results of this? How much in the past has this actually, how well is this actually done? Well, I used AI and I asked AI, what have been the results of the traditional dogs of the Dow approach? And this is what the AI result was. Now, this is not, I can't verify the accuracy of the result that I got here. So take it with a grain of salt, so to speak. But the result I got was it said from 1992 to 2011, it beat the S&P 500, okay, using the dogs of Dow approach. That would include dividend plus stock appreciation there. From 1992 to 2011, it beat the S&P 500. From 2013 to 2023, however, it actually trailed by a little bit behind the S&P 500. So the answer is sometimes it tends to do better than the S&P 500. Sometimes it doesn't do as well as the S&P 500. Here's kind of the difference that it was, that happens. Going back to the growth and value discussion that we mentioned before about how growth stocks often don't pay a dividend and or as much of a dividend, and value stocks tend to pay a little bit more of a dividend. When value stocks outperform, the dogs of the Dow approach is more likely to do better than probably just the average. If growth stocks are outperforming, then the dogs of the Dow approach is probably more likely to underperform. So having said that, let's talk about what we're seeing in the market now, and with the realization that things can always change in the market. In fact, if you want, you can look at growth stocks and value stocks. Oops, not 550. There's this is the S&P 500 pure growth index. So this is just taking the most growth stocks of the S&P 500. And you can put this on a percentage scale if you like. Let me go show prices percentage. And you can go S&P 500 pure value index. You're just going to add a V in its place, okay? And so over the past 5 years, what has done better? Well, value has done 42%. Growth over the past 5 years has done 74%. Growth stocks have outperformed. Probably not a surprise with the AI boom that we've seen. In fact, lately, what we've seen with the NASDAQ is, this is the NASDAQ, okay? NASDAQ has done really well. If you look just over the past month, the NASDAQ has been by far, in fact, let me do this. Let me bring up sector performance and look at different sectors, okay? And this is a 1 month performance right here. Look over the last month for IT, up 14%. Look at all the others. Nothing's even close to IT right now. So right now in the market, these tend to be more growth type stocks, okay? You can look at it different ways, but these tend to be more growth type stocks. And things like staples are going to be more value type stocks typically. And again, these are just generalizations. But right now in the market, this, tech's been doing well. But look, every good run comes to an end at some point. I'm not saying it's at an end right now, but after a while, it's probably not going to continue at the rate it's going up, put it that way. So in general, those are the results that we've seen from the dogs of the Dow approach there, okay? Now, let's talk about variations of this approach, because I gave you the mechanical approach. Start with the Dow, you rank it by dividend yield, you select the 10 highest yielding stocks, you allocate to them equally, you hold for 1 year, and then you repeat the process. Now, at the end of 1 year, it's likely that there's going to be a lot of duplicates that are still on there, but it's likely there's going to be some changes on there too. So what you would do is you'd take the 10 highest yielding stocks. If they're already on your list, you'd keep them. If they're not on that list, you'd sell the ones that you don't have anymore, that aren't on that list anymore, and you'd buy those on the list that aren't already in your account at that point. So that's how you would do that. All right. Now, so variations. Could you go to a further evaluation? What are some things that we typically look at in this webcast in terms of trying to ensure that the company isn't just paying a dividend, but we're going to look and see that it is, a good company that's going to continue to pay the dividend and perhaps have a good share price increase? Well, we're going to look at things like earnings stability. Could you screen these further for earnings stability? You could. It's not the traditional dogs of the Dow approach. Could you screen them further for cash flow? You could. Traditionally, in this webcast, you've seen if you've looked at past sessions. And if you look at past sessions, they are, we've talked about these: earnings stability, cash flow, payout ratio. Okay? And for a lot of these, such as payout ratio, you can just add a column here for payout ratio in there. Debt levels. We often will avoid looking for companies that have high or rising debt levels. Let me do one more, how about? And then it's going to be, this is a little bit more of a qualitative measure. And the last one I just kind of bring to light right now is business outlook, okay? So if you're not satisfied with the standard dogs of the Dow approach, which I already mentioned, one alternative is you could screen further for these, cut out any companies that don't look okay in these categories there. All right. Let me do this. Bogus Chinchilla in the chat said, what's the difference between dividend yield and yield on the watch list customization? I don't think there should be any difference as far as I know. I've always just used yield, but if you use, I think if you pull up dividend yield, it should show something similar to that. So I'm not sure other than that. Okay, let's go and let's talk about another approach that's similar to this, the dogs of the Dow approach. And this one is called the small dogs of the Dow approach, the small dogs of the Dow approach. And so what's the small dogs of the Dow approach? The small dogs of the Dow approach is instead of just looking for the highest yielding stocks, you you start with the highest yielding stocks here. So we got these 10. I forgot where we cut off on that. I think it was right around there. You take these 10 and you take the lowest share price of those 10. Okay. The lowest share price of those 10. So that would be, well, that's a low one, 45, $43, $78, 118. Am I messing this up? I think we got that. Okay. So these would be the stocks that you would do for the small dogs of the Dow approach. All right. So so let me go and by the way, well, let me go on this. What does this mean? This means there's going to be more concentration risk on these. You got 5 stocks instead of 10 stocks that you're investing in. If you have fewer stocks, potentially maybe even in the same sector or a couple in the sector or 3 in the same sector or something like that, you end up not just with more concentration risk. The consequence of that is you end up with more volatility, okay? More volatility. Volatility isn't a bad thing necessarily. Volatility isn't a risk-based, well, it's not a measure that says it's going to go down this much. It means it has more potential to go up more or more potential to go down more as well. It's not directional. It can go either direction. But when we're trying to reduce risk, what we're going to say is we're a little bit more concerned on the downside of the equation. So that's where that concern comes up. Now, but there's maybe more potential upside in that regard there. What about this again, here's an AI result. Again, I can't guarantee what the veracity of the AI results, but since 2000, the AI results said dogs of the Dow averaged about 8.7% annual average total return. The small dogs of the Dow averaged about 9.3% average return, which is interesting because, in general, in the market, I'm not just talking about dividend stocks here. I'm talking about investing in general. When you have, there's a theory of more reward, more risk. You guys have all heard that. Higher rewards, higher risks. Well, that kind of bears out very often in the market. And that is when you're looking at stocks that have returns, historical returns that are higher. And I said stocks, but let me just kind of talk about indices for a sec. Or groups, higher returns often mean higher standard deviations. Okay, so what do we mean by standard deviation? What we mean by standard deviation is the difference between the average and the highs and lows. Okay, put it that way. The good years and the bad years, if we put it in annual terms here. So the average, we're just going to say, is the mean or the average. Standard deviation is for say 68% of the years, one standard deviation, what's the range of that between the good years and the bad years? So typically, when you see something with higher returns, you're in line for higher standard deviations, higher risks on those as well. Okay? All right. So there we go. Let me go and look at this and go payout rate. What's the payout ratio? In the watch list, if you want to add, for example, the payout ratio, you can click on customize. And I think is it under dividend payout? Dividend payout percentage of earnings right there. Okay. Yeah, sometimes it's hard on this because you don't know whether it's listed as payout ratio or whatever. Here, dividend payout percentage of earnings. Okay. There we go. Now, if we were doing that, so that's the small dogs of the Dow approach there. If we are doing the small dogs of the Dow approach, maybe a little bit more of a slightly, not a ton, more aggressive approach there on that. So there's some conversation between the dividend yield and yield in the chat. And David, I appreciate your response there. It looks like yield updates with live market pricing, whereas dividend yield updates with underlying balance sheet data, which of course updates more slowly. Okay, like quarterly. Yes, that is true. The balance sheet data only updates quarterly. And so I appreciate your help on that because I wasn't sure off the top of my head on that, what the difference was there on that. So there may be a slight difference between these. I typically use the yield here as we're doing this. Now, that's the approach. That's the dogs of the Dow approach. So let me just kind of sum up with a couple common questions that people have there. And some of these I've already addressed to a certain extent, but does the strategy work better in certain market environments? Yes, in more value-oriented environments, more defensive environments, late cycle type environments, the dogs of the Dow approach would tend to work better. In an early cycle environment, okay, in terms of cyclical business cycle type environments, in a more growth-oriented environment, then the dogs of the Dow approach may lag a little bit. It doesn't mean it can't be used for diversifications in a portfolio, because in general, when you're looking at dividend stocks, they are a component of the portfolio that are probably not typically, unless you're searching for a very high dividend, as aggressive as some certain growth type investments in the portfolio. Okay. Stocks, what happens if one of the companies cuts its dividend? Okay, that's another question that people ask on that. That happens, by the way. We showed you the example on Intel. And of course, if it cuts the dividend, it would be taken off the list eventually there. And it's not just Intel. I picked on Intel today, but other companies have certainly cut dividends in the past. This is a different approach to a common approach that we often use in this webcast, which is called the dividend growth investing approach. Dividend growth investing approach, we're looking at earnings, we're looking at cash flow, and we're looking for high growth in those areas, high growth in the dividend rate. This isn't looking at past dividend payments. Dividend payments may not be going up at all, but if the stock has gone down a lot, then you could end up with this kind of situation there. And there we go. I mean, I think that kind of sums it up, and I don't want to belabor this further here. That's the dogs of the Dow approach, folks. One thing I like is it's a systematic approach that tends to take out the more discretionary parts of it, more of the emotional parts of investing. And you can do this at any time, but typically it's done on an annual basis. But you can start anytime you want. Often people will do it right at the beginning of the year, but you don't have to do it that way. Now, if you like the webcast, I invite you to hit the like on it, the little thumbs up. It does me a favor. I appreciate that if you do that. Also, if you like the webcast and you like Schwab webcasts in general, I'd encourage you to click on the subscribe button on the Trader Talks channel. The Trader Talks channel we have a whole bunch of different webcasts, trading topics, investing topics. This was more of an investing topic today. Options topics, futures, stocks. This was more stocks today. A whole variety. If you don't want to miss on those, just subscribe to the webcast, to the Trader Talks channel. Appreciate that, okay? Appreciate your comments in the chat. Good questions. Appreciate Scott for helping me out in the chat, of course. And I appreciate each of you. Now, coming up next, at next means the top of the hour, is Trading the Trend. So make sure you check that out. And you can, just one more time, you can follow me on X and follow Scott on X at Brentmore CS, at Scott Thompson CS for additional content throughout the week. Thanks for joining me, everybody. Have a great rest of the week. Bye-bye, everybody.